Very good evening, everyone, and welcome to your webinar this Thursday. And I hope everybody had your dinner already. Yeah, so thanks a lot for coming. And tonight we're going to have a very interesting webinar. Okay, so before we begin, please allow me to share with you a quote that inspired me. Oh, by the way, my name is Richard, and I'm the organizer for tonight's event. Okay, so let me share with you the quote, and it's a very inspiring quote to me. Okay, so this quote comes from someone we all know called Warren Buffett. And he said that if you don't find a way to make money while you sleep, you will work until you die. Now, some years ago, when I saw this quote, it really gave me a jot, a wake-up call, so to speak, and caused me to think about the things I'm doing, whether it can make money while I sleep, because I certainly don't want to work until I die. So the question is, where can we find ways that can make us money while we sleep? And that I think every one of us know that it's called passive income. Okay, so tonight hopefully you will see something interesting to you, like it has interested me, that can give you passive income. All right, so that we don't have to work until we die. All right, so let me continue. Now, to me, there are two paths to building your wealth or our wealth. Okay, then they are to be a driver or to be a passenger. So what do I mean by that? Now, to be a driver way to build your wealth, it is basically the DIY path, and that is you're an active participant where you are behind the wheel. You got to learn how to drive, pass the highway code, and then so you got to do everything yourself, basically DIY. Okay, so the other path to wealth is the passenger way. Now that is called DFY, or done for you. So this is the passive way. You just have to sit back, relax, sip your wine in your first class seat or your whatever vehicle that you've chosen, and then just enjoy the ride from wherever you are to your destination, to your financial goals. Okay, so between DIY path and DFY path, which is better? So this is not something you need to answer me, but you really have to think about it. Which is better for you? Which do you prefer? Now, to me, I think there's no right or wrong on which is a better way. I think that both ways can be done. Okay, so you take your pick, you make your own decision. Okay, whether it's a driver way or passenger way. Now, the question then is, where can we find service providers or education that can show us the way to DIY or to DFY? And because of that question that I asked myself is the reason why I and a friend of mine started a community called WEALTHENJOY, where we gather wealth building education and opportunities under one roof, and we share with our friends and their friends around us. Okay, so and just to give you a quick tour of what's inside WEALTHENJOY member area, when you logged in, you are going to see the same quote that inspired us to create the website. And then we will also encourage everyone not to put all your egg in one basket. Okay, we must diversify everything, so that no one hit is going to sink our financial ship, so to speak. Okay, so it's very important to diversify. So in there, in our member area of WEALTHENJOY, you're going to see a variety of education and opportunities where you can diversify to build your wealth. Okay, so I won't go into the details there. You can log in and take a look yourself. All right. And the question is, how much to become a member of WEALTHENJOY? And the good news is, it is entirely free. So to take a look at what we have gathered for you, the curated list of education and opportunity, please go to my.wealthenjoy.com. Okay, so, and to be informed of more wealth building education and opportunities, please join our Telegram channel, WEALTHENJOY. Okay, so with that comes to the very important part of the webinar, and that is the disclaimer. Now, you are responsible for your profits and losses. The speaker's opinions are their own and does not represent WealthEnjoy's opinion. WealthEnjoy is owners and sponsors and participants are not responsible nor liable for your losses. Now, WealthEnjoy events are for educational purposes only and should not be construed as advice. And when you are in doubt, please seek professional help. And with that out of the way, now today, as we know, there are two paths to wealth. I would like to share with you one of the paths, and that is the DFY path, where you can sit back, relax, and then get to your financial goals, because the invited speaker is from a company who can help us to do DFY. Okay, and and then also I promise you inside the webinar registration page that I'll share with you how you can get up to 2% more in your Syfe account, and I'll share exactly how you can do that at the end of the sharing today at the end of the webinar. And there will be Q&A. I'm sure you have questions that you ask our speaker, and please look for the chat box that somewhere on your screen. Either you may need to scroll up or down where you see the word chat, and then you can type your questions there. And then at suitable juncture during the webinar, I will get those questions and ask our speaker today. Okay, so with that, I'd like to go into our webinar proper, and that is on this very interesting topic about passive investing versus stock picking. Now, I'm sure all of you have a financial portfolio, and you either DIY or you DFY. The question here is, which is better? Right? And exactly how do you do it? Because there are so many service providers out there. And tonight, it is my privilege to be able to invite from Syfe, MAS regulated robo-advisor, their head of investment advisory, Ritesh, to share with us his opinion and his view about which one is better, passive investing or stock picking. And also, he will share with us how his company can help us to grow our wealth passively. So, Ritesh, without further ado, may I hand the stage over to you?
Hello. Hi, Richard. Thank you so much for the lovely introduction. And I must say, I think all the things that you mentioned initially in terms of how you are thinking about investing and creating a whole community, how to go about their investment process, I think it is highly commendable. And the reason I say that is, as Asians, as Singaporeans, recently, year over year, a lot of surveys are done. And what has been found is, as Singaporeans, we are really good at saving. But when it comes to investing, we don't do that great a job. So a lot of our money actually remains in our bank account at very low interest rate. And that's where I think, the first quote that you had mentioning about, the importance of money working for you so that you don't have to work for it is very, very relevant. So if you just be a little bit more proper and disciplined and, scout around a little bit in terms of doing some research, you will find that essentially just by taking a few steps, you can actually generate so much more value with your money, right? So I think in general, it is very important to, get started with your investment process if you have not yet done so. Now, I think the second part, which you mentioned, was around passive investing versus actively managing portfolios, right? And again, I also believe there is no right answer or wrong answer to it. If you are someone who genuinely has the time to spend on, picking the right stocks, doing the right research, analyzing the markets, and staying on top of what's happening on the global front, I think you can, be a stock picker and try to construct your own portfolio. But as we all know, yes, I mean that can be done, and if you are good at it, you can potentially generate substantial returns. But what ends up happening is we all are actually not money managers. We have our own life, we have our families, and we have more important things to do. What that means is, being on top of the market is not that easy. Plus, there is a huge time commitment associated with it. So even though you might save on a little bit of a cost standpoint because you're trading directly, and nowadays it is so easy to trade stocks and ETFs and other products because the brokerage platforms make it really, really simple, really easy. The cost of investing is really low. So if you do have the time and you are ready to spend that time, I think it's really easy to go about and create your own portfolio. But I think there are two things that you need to be aware of. Number one is the time commitment. So that's an implicit cost, right? Because that time can potentially be spent on something much more important to you. The second thing is the explicit cost. So the explicit cost is in the form of you, paying those transaction fees, paying to sort of, do any rebalancing and, optimizing the portfolio. And a lot of effort and time needs to, again, be spent to be able to do that on a continual basis, right? So the explicit cost can also be in the form of actual performance of your portfolio. So, leave aside the time commitment, leave aside the actual cost associated with trading. Maybe those are coming down. But what about, how do you know what you have chosen is the right thing to do? And a lot of us, what happens with active stock picking or active investment is we get driven by emotions, we get driven by biases, and we get driven by highlights in the news. And what that tends to do is we tend to follow the crowd, and we just invest into stuff which might have short term runway, but it is more of a hunch kind of an investment rather than thinking on a very long term wealth accumulation, diversification, all of those incorporated per se. So I think very important to have these costs in mind, even though you think it is fairly straightforward and easy thing to do. I think these are very important things to keep in mind, because if you are investing in a certain stock like Tesla or some of other ones which can go down substantially but then can skyrocket and stuff like that, you need to be able to ride that volatility associated with those individual investments. And typically, again, you tend to overexpose yourself to certain names. What that means is you should also be ready to take huge losses associated with those investments. So again, the idea is if you want a very steady journey in terms of your investing, the only free lunch left is actually diversification. And diversification actually is very easily available nowadays with platforms and with vehicles which are known as ETFs. So when we come to passive investing, ETFs are supposed to be those instruments that help you invest on a broad-based basis and invest into the most successful companies because you're investing into a broad-based index. So typically the difference between an active management and passive investment management is that when you are investing into an ETF-based portfolios, the ETFs are supposed to track a broad-based index. And because you are not actively sort of calling on one sector or the other or one stock or the other, you will get a broad-based investment return based on how the broader market behave, right? So what that would mean is essentially your journey to wealth accumulation will be a lot more stable. It will be a lot more steady. And hopefully because of that, you will experience lesser fluctuations and volatility with your portfolio. And again, with that, you can also construct these passive investment vehicles are available across asset classes. So, not just stocks. I think it is important to have asset classes such as bond and gold in your portfolio because they are oppositely correlated. And what that enables you to do is, again, when the markets are super volatile, these are the elements that help you protect your portfolio from a downside standpoint. So now I think, I'll pause there a bit. I will actually start sharing my slide so that you guys have a better idea about Syfe as a platform where we focus solely on passive investing, and we focus on creating curated portfolios for investors who ideally would want to get good returns, but they might not necessarily have the time. Or, there are all these, when you sort of think about all the implicit and explicit costs, it is not worth the time and effort, even though you might be able to do a good job. So I will cover some of those aspects in terms of, what Syfe as a platform offers and what are the different options that you can utilize within our platform. So let me stop this sharing and start to share my screen. All right, so, okay. I hope everyone is able to see my screen now. So essentially this is, Meet Syfe. We will go about introducing who we are, what we do, and I will cover a little bit about our different portfolios and our investment framework as well. So just to give you a quick glance into what Syfe is and how we started off. So Syfe started off in 2017. We are a Singapore headquartered company. The initial couple of years were spent to sort of develop our investment strategy as well as our technology platform. And around 6 to 9 months were actually spent to secure a license from MAS to be able to offer our investment strategies to retail and institutional investors, not just in Singapore, but around the world. Right. And somewhere in June, July 2019 is when we started offering our portfolios for everyone. And since then, we have launched a few offerings on our platform, which have been taken very, very popular vote, and people have enjoyed their journey with us so far. And we continue to innovate in terms of the different offerings that we have. And most of our products, as you will see later, are geared towards long-term wealth generation and accumulation perspective as well. If you look at the executive team, everyone comes with a high degree of pedigree as well as expertise in their respective segments. Dhruv was the head of equity and ETF trading at UBS, spent close to 10 years there. And that's where we, I think, came up with that whole paradigm of using only ETFs in our platform, because we have a sort of a fundamental belief that active management over a longer duration tends to underperform the broad-based benchmarks. So if you just do some research, what you'll observe is 90% of active managers, they actually underperform the respective benchmarks that they track on an after-fee basis. So the idea is, if the active managed portfolios are underperforming, then why do you want to pay active management fee to those kind of platforms? You rather invest into a platform through which you can just get access to the indices themselves, right? So I think Dhruv was like a big proponent of essentially creating a portfolio which is low cost in nature. It's very transparent. It uses instruments which again track the market on a passive basis. But at the same time, we curate a portfolio for you so that you don't get confused in terms of which ETFs to pick, how much to pick, and how do you sort of allocate between them, right? And that's where I think Richard comes into picture. He's the head of portfolio construction and risk management, 30 plus years veteran in the financial services industry. He's also an ex-professor at NUS Business School. He's got, again, high expertise working with hedge funds, banks. Previously was CEO of UOB Venture Management. And then essentially the rest of the team followed through as well. Sebastian was the CMO of Lazada before joining us. Akiko, who is sort of our rocket scientist. She is a PhD and is currently the senior financial engineer and risk manager. And I myself joined Syfe last year from Goldman Sachs, where I used to be a private banker and cover ultra high net individuals and family offices. So as you see, like, the investment team is very, very, ingrained in terms of, the expertise level in different investment opportunities that you would, sort of observe in the market, and knows how to curate portfolios that are geared for, solving the long-term needs of the clients, right? So quickly, I think this is very important. I think the operations and licenses part, I think it is very important to point out that we have a retail fund management license. By virtue of this license, what this ensures is clients, when they invest onto our platform, they don't have a counterparty risk to Syfe. This is ensured because when we invest on behalf of clients, we are required by MAS, which is the Monetary Authority of Singapore, the local regulator, that we keep client assets separate from our own assets. What that means is, even in a worst case scenario that something happens to us as a company, all your assets are safeguarded and you can redeem all of them in full. So when you sort of invest with us, your money is actually kept, in terms of the money, the funds itself, they first come to a DBS Trust account, and when we invest on your behalf, they are traded through Saxo, and then they are custodied with HSBC and Citibank. So again, very, very big names, very reputed names, and essentially make sure that whether Syfe exists or not, your assets will be safeguarded. And again, I mean, that's like a worst case scenario. We are here to stay. If I had to point out one more thing, it is important to note that just in September, we raised our Series A funding round, which was $18.6 million. It was one of the biggest Series A funding round that we raised. This was led by a very well-known venture capital firm, which is called Vallar Ventures, and they have invested in some of the biggest wealth unicorns or wealth tech unicorns in the world globally basis, right? So this just goes to show you that institutional investors have recognized the kind of platform that we have built, and they are fairly optimistic in terms of where they see us going. So I think that also is like a vote of confidence that essentially you are investing with a platform where we are there to stay, and we want to invest for your long-term needs, whether it is retirement, children's education, or any other goal that you might have. Right. So now I think quickly going into our product offerings, let me quickly cover this. As I was covering earlier, our focus is passive investing, but at the same time, we don't want to be like a broker where you get too many options and then you are confused as to what to buy, how much to buy, in what proportion to keep them, and how to rebalance it, and so forth. So in our platform, what we do is we have created portfolios that broadly align to long-term goals that clients could have. So typically, when you as an investor are thinking about investing, you have a few goals in mind. A goal can be you want to grow your wealth. So whether it is for your retirement, whether it is for your children's education, whether it is to buy a house, these are all goals where you want to grow your money, right? So that's where I think the global and equity 100 portfolios become a little bit relevant, and I'll talk more about them later. And the second goal that typically people have is to generate some sort of a passive income, and that's where our REIT Plus offering takes effect, because REITs are known to be a steady dividend payout investment vehicle, and a lot of Singaporean investors, they love the aspect of getting a cash flow on a regular basis as passive income, which is what I think REITs do, because by law they are required to pay out 90% of their income as dividends. So what that means is they give out a sustained basis, they give out a regular flow of cash, and that becomes a vehicle for you to then sort of enjoy a good sort of cash flow passive income strategy on a regular basis. So now I think when you're looking to grow your wealth, the reason I think the global and equity 100 make a lot of sense is because typically as Singaporeans, we already have too much exposure within the country. And if you want to sort of grow your wealth, typically you would look at the equity markets. When you look at the local Singapore equity markets, frankly, what I have observed is the returns are really, really low. And if you look at the last 10 years, for example, I think the returns are negative. That's typically because there are more like stable companies, low growth companies, blue chip. They are really great, but in terms of growth, they are not that great. So essentially, if you want to really grow your wealth, you need to look outside of Singapore and on a global basis. Because if you look at this, for example, the US market, it's grown like more than threefold within that time frame. So essentially, if you want to invest into a vehicle that gives you substantial asset appreciation over time for you to realize all the long-term goals that you have, I think it is important to have a more globally diversified portfolio. And that's what I think the global and equity 100 do for you. So the difference between global and equity 100 is that the global portfolio focuses on a mix of equity, bond, and gold. So it's more, as I said, stable portfolio because it is more globally diversified, plus the risk associated of investing into an equity-only portfolio is sort of mitigated by the presence of bond and gold, which act as instruments that help you contain the volatility of your overall portfolio, keep it even more diversified. And because they are oppositely correlated to a certain extent with equity, they act as downside protection on your overall portfolio as well. Now, I think one thing very unique about our global portfolio, and I'll talk more about it later, is that we have a portfolio designated based on quantified risk numbers and downside numbers, rather than very vague terms like moderate, aggressive, conservative, right? So that way is, I think, psychologically as investors, it is much more easier to understand what exact is the risk that you're taking while investing into this portfolio, and then you can decide how much to go about changing your proportion of equity, bond, and gold to sort of balance the returns with the amount of risk that you are sort of comfortable with. At the same time, the equity 100 is a more I think sort of an alternative to a DIY kind of a strategy, where all of us again want to maximize our return. And if you want to just invest into the stock market, again, typically you can do it yourself by choosing individual ETFs or individual stocks and creating your own basket of these instruments. What we do in the equity 100 is we have a smart beta strategy, which ensures that the way we construct the portfolio, it maximizes your return, but at the same time tries to minimize the risk that you're taking with it. So it's a pure equity portfolio. And the idea is, again, we want to remove that hassle from you in terms of spending time and effort in choosing the underliers for your portfolio, keeping them balanced at all times, keeping track of the market. In a way, you are sort of outsourcing all that job to us. We ensure on a continual basis that we will pick the right ETFs, we'll keep it in the right proportion, and we will optimize the portfolio to really sort of maximize your returns and also sort of minimize your risk. So I think will be very interesting, I think, later on to share more about equity 100 as we cover. And I think happy to take questions on that as well in terms of what that smart beta strategy means and how we implement it. And then lastly, I think the REITs portfolio, as the name suggests, we invest into the Singapore REIT market. This, I think, is a very unique offering. You will actually not find it in a lot of competitive platforms. And the reason is, this product is built in partnership with the Singapore Stock Exchange. The Singapore Stock Exchange has an index called the iEdge S-REIT Leaders Index. It contains the top REITs in Singapore. The largest and the most tradable REITs are sort of present in this particular index. So in a way, these are the most successful REITs in the Singapore, sort of REIT landscape. And what that means is right now there is sort of no ETF that tracks this index. So we have got the license from SGX to track this index. So when you invest into our REIT portfolio, you are investing into this index on a passive basis. And again, because it is containing all the high quality REITs, it is usually done much better than an actively managed REIT strategy, where it could have had certain exposure or a certain concentration into, say, retail malls or office space, which might not have done that well during the pandemic situation. So this portfolio and this index is fairly diversified across different sectors. So it also has industrial, logistics, data centers, which have done really well and mitigated some of the negative returns that you've seen within the retail and office space within the REIT segment. But in general, I think the reason people love REITs is because of the combination of income and growth, because REITs do generate a substantial amount of passive income, roughly in the range of 5% as dividend yield. But on top of that, the REITs also appreciate in value. So it really is an instrument where if you don't want to take a currency risk, because equity 100 and global are USD denominated portfolio, if you want to invest in a more Singapore dollar manner, the REIT portfolio could be interesting because it gives you that mix of income plus growth for your portfolios, right? So I think I will now go into detail of each one of these portfolios and how you can use it and stuff like that. But before that, I think quickly we'll pause if there are any questions. Otherwise, I'll continue.
Okay, thank you, Ritesh. And we do have one or two questions from the early birds. And for the rest of you who are here with us, over the 100 of you, if you have questions, please look for the chat box somewhere on your screen on your mobile devices. You may need to scroll around and you can type in your questions there anytime. And whenever at a suitable juncture during the webinar, I will post the questions to Ritesh to answer. Okay, so now the question that I see are one from Cody. He or she is asking whether there are any taxes on the gain.
Got it. Yeah, so I think generally there is no tax on any capital gains on your portfolios. But on the global and equity 100, because there are certain underliers which are US denominated or US listed ETFs, they do have some dividend withholding tax. But even that we have sort of optimized because we have moved certain ETFs to the London or the Irish domiciled ETFs, which have lower dividend withholding tax. So where possible, we have optimized those situations for our clients. For REITs, actually, there is no sort of um, uh, tax implication, whether on the dividend or on the capital appreciation. So REITs, you don't have to sort of worry about. Only on the global and equity 100, there are some dividend withholding tax. And again, one thing you guys need to note is that global and equity 100 are more growth oriented portfolios. The dividends tend to be like a very small component of your return, and if there is a tax on the dividend, it doesn't really impact your overall returns from a very meaningful way. So I'm not too concerned about that with dividend withholding tax, because again, we tend to also optimize it. If there is a equivalent Irish domicile ETF, then you can reduce the withholding tax for your dividends, and that's what we do for certain ETFs where it makes sense. But a lot of ETFs, what happens is if you move to the Irish domicile, the liquidity goes down, the cost is higher. So it doesn't make sense to go for the Irish domicile, even though there is lower dividend withholding tax. So again, people, I think on a superficial level would have those questions and all. But I think if you dig a little bit deeper, I don't think that should be meaningful enough for you to be too worried about. And generally, again, as I said, for global and equity 100, bulk of your return will be dominated because of the capital appreciation, and for capital appreciation, there is no tax.
Great, thanks for the answer. So let me see. There are some questions that are more portfolio specific. I will keep those questions to the respective sections, because I believe the questions will be answered by Ritesh during those segments. Let me see what is some more general questions. Okay, Colin is asking, any inheritance tax implications for US holdings?
Is it the same question, or is it? Sorry, I didn't get the gist of it.
Inheritance. Yes.
All right. So I think this is again a good question in general. The way our firm is set up and the way we invest, because we pool together all client assets and invest on a omnibus manner. Typically, our view is that inheritance tax is not applicable, because we pool together all assets and invest on a portfolio basis. And what that means is, on an individual client standpoint, you don't, or you should not be having an inheritance tax kind of an implication, which is typically the case when you invest directly through a brokerage platform and you buy into individual stocks or ETFs, because there you have direct exposure to those instruments, versus here you are sort of taking exposure to a vehicle that we provide and we manage. So in a way, that vehicle sort of should not be having that inheritance tax kind of an implication. But again, I mean, I should not be advising on the tax matters on a on a more detailed basis, or in a way which is I don't know the details about this person in terms of the background and where from, which nationality, or what exactly is his situation. So I wouldn't be able to tell exactly, but broadly, if you're investing, we have checked with our compliance team and our legal team and all, and their view is that inheritance tax is not applicable.
Right, thank you, Ritesh. Now, the next question comes from Alice, and she is asking if if she invests and halfway through the investment she need the funds due to some emergency or some use of the funds, and then she withdraw the investment, would the dividends be paid out up to the time where she withdraw?
Absolutely. So, number one, on our platform, by the way, there is no lock-in, so you can take your money out at any point of time if you do have those emergency needs. So we won't penalize you. There will be no exit charges per se. Plus, yes, I mean, absolutely, if there was any dividend that came in, even on the last day of your investment, you will be paid that out.
Right, good. Thank you. Now, Pat is asking, for the global and equity 100, what happens if he die? will the share or will his investment attract estate duties in the respective country?
Right. So I think covered this a little bit earlier as well. Normally because you're investing on a portfolio basis, our view is that estate taxes and inheritance taxes should not be applicable. The process should be as simple as, usually, and this is a standard process across different firms as well, that if someone, passes away, then whoever inherits the, sort of property, they'll usually have like a will written in terms of who should be apportioned what portion of their sort of assets and monies and investments. So there will be like a probate and stuff like that that need to be submitted to us, and then whoever comes and furnishes those details, we will just transfer over those assets to that person.
Right. Thank you, Ritesh. And Pat actually had a follow-up question. I think Pat might be from the US because he's asking, he's saying that there is a difference between inheritance tax and estate tax in the US. So
Yep.
now I think for the more specific questions regarding different nationalities, you can take the question to
Exactly.
Syfe directly after the webinar. Okay, thank you, Pat, for your questions. Now, next question comes from Ella. Ella is asking, when and how often are dividend paid out?
Sure. So, okay, for the global and equity 100 portfolio, because they are growth oriented portfolios, we automatically reinvest the dividend back to the portfolio for it to grow. But at any point of time, if you want to withdraw even partially, you can just do partial withdrawals from any of the portfolios. So that is possible. But again, the intent is that the global and equity 100, because the dividend portion of the return is anyway so small, it makes more sense for you to reinvest the dividend and let it grow. For the REIT portfolio, because the dividend is a substantial portion of the return. So typically, if you invest into a 100% REIT portfolio over the last 10 years, the returns have been around 8 to 9%. And what that means is out of that 8 to 9%, 5% is your dividend, 3 to 4% is the capital appreciation. And that's why I said it's a combination of income plus growth kind of a portfolio. Now, the dividends from the REITs portfolio, there are two choices. You can either reinvest the dividend or you can choose to pay that dividend out to you on a quarterly basis. So those two options are available for the REIT portfolio because it does have a substantial amount of dividend as a instrument, as a vehicle, and a lot of sort of older investors actually want that cash flow to come in on a regular basis to them as a passive income. So we have that facility for you to automatically get that dividend credited to your bank account on a quarterly basis if you want to choose that.
Right. Thank you, Ritesh. And next question comes from Colin, and he's asking how fast are funds processed for deposits as well as for withdrawal?
Great question. So essentially, we have a cutoff. So every morning, 11 a.m. is the cutoff. So if you transfer funds before 11 a.m., and assuming you have put the right portfolio reference code, so each portfolio in your account will have a unique code associated with it. And the way we understand where you want to put the money to invest is based on the portfolio reference code that you put when you transfer the funds in. So essentially, as long as you put the right portfolio reference code and the money comes in before 11 a.m., it will get invested the same day, right? So the money gets invested on the same day if you meet the 11 a.m. cutoff time, Singapore time, right? In terms of withdrawing, again, the same thing. If you sort of send your withdrawal instruction before 11 a.m., then the assets will be sold off on the same day, right? And then money will be credited back to your account in 2 to 3 days. So basically, it takes a couple of days for the trades to settle, and then it takes 1 day for us to send that money back to your bank account. So overall, that's roughly the cycle. But essentially, I think the important point to note is if you send any instruction before 11 a.m., it gets executed the same day.
Right. Got it. Thanks, Ritesh. And the next questions, or rather the next question, yes, comes from, I think it's called Yen Mei. And she is asking, as the banks and other institutions are behind your platform, right, how can you achieve a more competitive package than those banks, what they are offering?
Right. So I think the biggest advantage that we have on our side is technology. Typically, the banks, the way they are set up, they have the traditional sort of platforms to sort of they have to make do with what they have, and all these potentially more scalable options are things that they are exploring right now, and they have taken some steps to come to that state as well. But in our case, our whole aspect of being able to provide you these solutions, these are fairly sophisticated solutions, and they come at a really low cost. And the reason we are able to do that is, number one, we have built this from scratch. We have built it from a standpoint of technology first, and digital first. What that means is we call ourselves a digital wealth manager. So when you build something with a tech first sort of initiative, what that means is it becomes a very scalable system, and we don't have to hire an army of operations and sort of other folks from a capital intensive and human resource intensive standpoint who need to do manual work, right? So because everything is so automated, it is also technology driven. A lot of our processes are automated. We have our own fund management system. We process everything, and these strategies are all automated in terms of how they process all the client funds inflows, then do the trading, and then sort of settle the trades, and then allocate it back to the individual clients. Everything is built in-house. Everything is sort of proprietary. And what that enables us to do is basically build a very scalable system. And over time, we achieve sort of economies of scale, because if more and more users come and use it, number one, we can keep reducing the cost, because our sort of technology investment is a one-time thing, and every incremental cost is fairly limited. Versus if clients keep coming in and put more of their money, then essentially our revenue starts to grow, and essentially we can then pass on more and more benefits back to clients. So I think that typically the banks will also have an army of advisors. Their incentive structure works very differently, where they would market more active strategies, because the way the advisors are also paid is based on on an incentive structure, where the more active funds they sell, they will get a certain amount of commission, and they will also get a trailer fee back from the fund managers and all. So essentially, I think that world is ripe for disruption, because now it's becoming increasingly much more transparent for people to observe that they are getting ripped off in terms of all these high fee sales charges and annual management fee, and on top of that, the actual active funds sort of underperforming overall. So I think people are increasingly looking at more digital options, and they're ready to pay some fee. I don't think anyone wants everything for free, but where there is value, they're willing to pay, and that's what I think we bring onto the table.
Wonderful. Thank you, Ritesh. And one of the, let me see. Okay, let this be the last question for this segment. And the question is whether there is, I know there is no minimum to make the investment. And I think the fee structure later on you will also cover. But one question from one of our attendees is whether there is a minimum amount for withdrawal.
There is no minimum amount for withdrawal as well. So you can withdraw as much as possible or as little as possible. So that facility is also available. So partial withdrawals are possible.
Right. And there's no fees associated with it, is it, for withdrawal? Sorry, couldn't hear you.
Sorry, yeah, so there is no fee associated with it.
Right. Okay. So I hope that answers your question. One of the attendees have asked that. RW. Okay. So let me see. Colin is asking whether can set up a joint account with a minor.
Right. So I think this is yeah. Sorry. Go ahead.
I think for Syfe, the minimum age is 18. I did ask this question also because I want to set up one for my son, but he hasn't reached that age yet. So 18 is the minimum. So Colin's question is interesting, setting up a joint account with a minor.
Yeah, so I think right now we don't have that option available on our platform. We will potentially work on it. There have been some requests for this kind of an offering where you can open a joint account with a minor. But I think we will need to do some more work on it, and it's not been the most sort of requested feature. So I think we focus on more products first and giving you the right strategies. But at this point of time, the way to do it would be you create a portfolio for your child and name it as such within your sort of account, and then later on, once the child reaches that particular age, you can sort of transfer over those funds to him. And again, I mean, even that is not yet built out, but that would be one way of doing it. Like, even if it requires you to sort of on one day sell off the portfolio, take the proceeds, and give the money back to the son to sort of create his own account and invest again, because one day the markets won't change that much and we absorb all transaction charges per se. But later on, I mean, I'm sure that we will build those facilities where these joint accounts should be possible as well.
Wonderful. Thanks for taking the first segment of questions, Ritesh. Please take back the slides and let's press on. And by the way, can you press the hide button on your slide so that there's a little bar on the bottom? It's blocking some words. Hide.
Got it.
Yeah.
Got it. Yeah.
Okay, wonderful. Okay, please continue, Ritesh. And I know we have some questions regarding certain product-specific things, and I think Ritesh will cover them as he go through each product. So please carry on, Ritesh. Thank you.
So also, I'm a little conscious of time. We are, I think, already 45 minutes in. So I will, keep it short and simple for each product as well, and then go, like more on a Q&A basis, because I think that's more interesting, because people can directly ask me those pointed questions about each one of them, and then let's go with that, right? So let's quickly review each of the three portfolios. As I said, the Syfe Global, one differentiator that we have in our portfolios is that we have a risk-first approach, because returns are things that cannot be predicted. But risk can be managed, because no one can guarantee you that I will generate you 10% return year over year over year. That's simply not possible. And if someone is doing that, essentially, please introduce that person to us as well, because beyond, say, a fixed deposit or some very, very safe instruments, only those are products which have some guaranteed returns, and they tend to be very low returns per se, 1-2% at max. Anything beyond that basically means you are putting your capital at risk. So what is more important then is to protect your capital and manage the risk of the portfolio, rather than going simply after returns. So what you should be more concerned about, maximizing your risk-adjusted return, rather than just trying to maximize your return and going for the highest potential return portfolio. So the idea is, if Tesla is going 3x times up, doesn't mean that it will continue to go that trajectory. It can, but it can also come 2x down. So that's where I think the risk is that much more important to also be mindful of. And this is, I think, an important slide where essentially a lot of us don't invest, or we constantly think about timing the market, mainly because we are worried that what if I invest and the market goes down. And typically, we also panic sell a lot, right? And what happens is, if you look at this chart, we think that markets is a one-way street, and last few sort of months you've seen the markets just keep going up. But the fact is, if you look from a history standpoint, every 3.5 years there is a 20% or more drawdown if you're investing into an equity-only portfolio. And how much ever we think we are good at investing, or we can navigate the market, whenever the market corrects 5-10%, the first thing that we do is like sell, and let the markets sort of stabilize, and then I'll come back. A lot of people actually sold off their investments during the US election risk or election period, and by the time they came back, the market already rallied back 10%. So I think it's very important to these risks and not sort of get too perturbed and end up sort of cashing out your investments, because these things will keep happening. And what is more important is, if you manage the downside of your portfolio, it is easier for you to sort of keep yourself invested rather than cashing out. So for example, in March of 2020, the markets actually went down 35%. If you had that kind of a drawdown, I am sure a majority of investors liquidated their money. And essentially, if you, instead of losing that 35%, if you could have managed the downside of your portfolio to say only 10%, the amount that you would have needed to recover would have been much, much lesser, right? You would only need 11% recovery to go back to even. But if you lost 34%, you need 50% recovery. And that's where, people sort of start to panic and, they have a bad investing experience. So if you can have a strategy that sort of protects the downside of a portfolio to a certain extent, and then helps you navigate the ups and downs of the market in a much more stable manner, that will keep you invested rather than sell off right at the point when it is a sort of worst time to take money out of the table, right? And that's what like the Syfe portfolios do. It's a performance chart, but essentially in our case, instead of having a portfolio which is static in terms of asset allocation, where equity, bond, and gold remain stable, we actually target the portfolios from a downside risk standpoint. So on day one, when you come onto our platform, you tell us what is the sort of stop loss or what is the maximum drawdown that you're willing to take on your portfolio. So these drawdown numbers are from 5% all the way to 25%. So what you're essentially saying is, so for example, if you choose 15% risk, you're saying that whether the market goes down 20%, 30%, I don't care. I want this portfolio to not have a drawdown beyond 15%. And based on that as a constraint, can you maximize the return of my portfolio, right? So then I think psychologically you have a certain, comfort that someone is managing over my money and they're keeping the assets in my portfolio, fairly diversified and across asset classes, and the proportions are maintained in a way to make sure that the drawdown in the portfolio is limited to a certain extent, and it's a quantified number, right? So it is not a vague term like moderate risk. So that I think is very important, because that's one thing that keeps us, away from investing. So I think on day one, if you are willing to take a 15% drawdown and you know that your losses will be, or temporary drawdowns will be contained to that level, you will be much more comfortable keeping your investments there for the long term and wait for the portfolio to recover as well. And that's where I think, like, if you look at the overall return profiles, like, the annualized 10-year returns, they tend to go up the higher risk you take. But of course, then you should also be ready for higher, volatility as you move up the risk curve. But I think, again, very important to note is that these are quantified risk numbers based on which you can choose portfolios and invest into them, which is very unique compared to a lot of other platforms that you will see in the market. This is just a quick peek into the investment universe. So all the equity sort of ETFs, all the bond ETFs, and gold as well as diversifiers and sort of asset protectors overall. So let me actually also cover quickly Equity 100 in the wake of time. So essentially, if you look at Equity 100 portfolio, the way it differs from the global portfolio is the global portfolio is a mix of equity, bond, and gold, versus the Equity 100. So it's a combination of equity, bond, and gold, versus Equity 100 is a pure equity portfolio. And again, as I said earlier, typically for DIY investors, I think this is a perfect alternative if you want to, spend less time, sort of gauging the market and keeping on top of it, and constantly trying to reallocate and readjust and reoptimize your portfolio. This portfolio already has those elements incorporated. So what is Equity 100? So Equity 100 is a 100% equity portfolio. It doesn't have any bond or gold in it. So the idea of this portfolio is to maximize your return. And on top of that, it uses a smart beta strategy, which basically mean that we are trying to construct this portfolio by investing into ETFs. But typically, if you invest into a broad-based ETF like S&P 500, it is typically constructed by having the highest market cap stock as the biggest component and the lowest market cap stock as the smallest component, which basically means that your returns might get dominated by a very few holdings per se. What we do is in Smart Beta, we, instead of doing the weighting based on market capitalization, we focus on certain factors which have been proven to be things or factors or sectors that drive returns to the portfolio, at the same time reduce the risk of the overall portfolio. So again, the portfolio itself is supposed to be investing into the some of the best known stocks in the world. They are invested through broad-based ETFs. So if you see, all these companies are very, very well known, very blue chip. They are the global growth engines right now, if you were to say so, in terms of how the market and how the overall equity market is going. And the idea is to pick all of these global companies and put them all together in one portfolio, versus if you were to individually buy these things, for example, Apple stock, if you want to buy, like, right now after stock split and all, it's $100 something, but it used to trade at $300 plus, and minimum lot size is 100 units. So you will need 30,000 US dollar to buy Apple stock, versus in our portfolio you get a very diversified portfolio. There is no minimum, so you can invest like $100 and you will still get access to all of these really high quality companies, right? So that's the whole idea of an equity 100 portfolio. As I said earlier, we follow a smart beta strategy. It's a rule-based quantitative strategy which concentrates on certain factors like growth, volatility, and size. So we will basically have weightage in the portfolio more tilted towards either value or growth. We focus on large cap companies because they have been much more stable during this pandemic period. And then we focus on low volatility stocks and sectors because that helps us mitigate the risk of investing into a pure equity portfolio. And the way we do it is by having a portion of your portfolio invested into sectors such as consumer staples. You see, like, this is 16.8%, and healthcare and utilities, which are supposed to be like fairly stable components of an equity portfolio, and sort of again mitigates the high risk, high return of your exposure to, say, technology names and consumer discretionary and other sectors per se. So it's again follows some sort of like a barbell strategy and tries to maximize your return, but at the same time keep the risk of the portfolio fairly contained, right? And that sort of shows up in terms of the performance of the portfolio. If you look at the graph on the left, this is an annualized 10-year return. The equity 100 generates 10.65% annualized return versus the S&P 500, which I said was like a market cap weighted index. So it's roughly generate 1.5% outperformance against S&P 500. And we are not taking an active bet on individual stocks and all. We are using a rule-based way to sort of extract those factors that really are driving this outperformance. And this is like a consistent basis. Even for this year, you'll see equity 100 sort of outperforming S&P 500, and this is consistently the case over a longer duration. And as I was saying earlier, even on a risk-adjusted basis, so the standard deviation of the equity 100 is the lowest compared to all of these other sort of benchmarks. And what that means is Sharpe ratio, which is known as the risk-adjusted return metric to track, is the highest for our portfolio, right? So again, if people want to get more technical, happy to take it separately. But the idea of this portfolio is to really maximize your return and reduce the risk. And again, we take care of it without you needing to sort of spend enormous amount of time to think about which underliers to buy and how to optimize them. Right. I think this was one question that came in earlier in terms of withholding tax. I think I already covered it. We have switched over like an S&P 500 ETF. Instead of using the US one, you use the Irish domiciled one. So it reduces your withholding tax. But there are some other ETFs like QQQ. If you buy the European one, you will actually end up paying more, right? So even though the withholding tax is lower, but the management fee is higher for the European one. So it actually makes sense to keep the US ETF for that particular need. So again, whenever there is a withholding tax question, rest assured we have done that homework to only give you a most optimized portfolio, whether it is with respect to tax, whether it is with respect to risk, or whether it is with respect to sort of optimizing your returns. So I'll quickly stop here before going into the REITs portfolio to take some questions on the global and equity 100.
Okay, and thanks, Ritesh. Just one question here, and that is from Cody, and he is asking whether how often do you rebalance?
Right. Okay. So for the global portfolio, it's a dynamic portfolio where essentially we are targeting a risk level. So on a daily basis, we monitor the risk of the portfolio, and as long as the risk of the portfolio is within a particular threshold, we don't rebalance. But if the risk of the portfolio is too far away from the chosen risk level, we trigger a rebalance. So it's a little bit of a more dynamic portfolio, which means the portfolio can be rebalanced if there is a high bout of volatility in the market. But typically what we have observed is the portfolio on average balances itself around 3 times a year, roughly. So that's the global portfolio. The equity 100 is a more sort of stable and static kind of a portfolio where we don't want, again, to have an active view on the market. So we adjust it and re-optimize it to bring it back to a highest Sharpe ratio kind of a portfolio every 6 months. And the reason for that, again, the factors that we track, they are long-term factors. They are not short-term trading factors. So the idea is these factors will sort of reverse course over multi-year. For example, growth has outperformed value over the last 10 years. And even though there is a huge talk about rotation between value and growth, so far it's not happened. It's starting to show up a little bit. And what we had done just recently in our last rebalance in October was we still have a growth tilt, but we have reduced the exposure to technology a little bit because of the high runway that they've already enjoyed. And we added some exposure back to the low volatility sectors and all. So I think those kind of things happen to sort of keep the portfolio overall optimized. But overall, it's a twice a year kind of a mechanism. And then the REITs portfolio, again, is a 2 times a year. Here, we just follow the index because the SGX index that we track rebalances itself every 6 months. So we also rebalance every 6 months. So global is dynamic, equity 100 and REITs are basically on a 6-month basis.
Right. Thank you, Ritesh. And Cody got you. I'm sorry, you are Miss Cody. Okay, Miss Cody. Thank you. Yeah. Sorry. Yeah. Okay. So Cody also have another question. She is asking whether she can invest SRS or CPF funds.
Right. So we are actively working on SRS. Our application is right now pending. We would want to launch that as soon as possible. So right now it is cash only, but hopefully SRS will come soon. CPF will take a fair bit of time, in my opinion, because the investment universe of CPF is very limited. And again, there are a lot of sort of active managed funds there for investment purposes. And again, we tend to focus more on passively managed instruments, which are ETF implemented. So I think the CPF will take a little bit more time as things open up over time. And MAS is and the government has been very, very forward looking in terms of what they have been able to offer us and platforms such as ours. So I'm fairly optimistic on those things as well. But I think the nearest is basically SRS. So you can look forward to having SRS investments in the next year.
Okay, thank you, Ritesh. And the last question for this segment would be from Chris, and he is asking whether the returns that you have shown comparing equity 100 versus S&P 500 and the MSCI, are they computed net of Syfe fees?
No, so they are gross of Syfe fees, and again, even the indices are basically gross of fees, right? So you cannot directly invest into S&P 500 and MSCI World. You have to sort of choose an ETF that sort of tracks this index and invest into it. So there will be some fees and costs associated with that ETF as well. But roughly, I think if you consider Syfe fees on average, you are paying around 0.5%. So even if you consider that 0.5% cost on a net basis, you still outperform, right? And again, the point is overall, it is not just the outperformance that you should care for, but it's really the portfolio, the way the portfolio is constructed, and the optimization in terms of the risk-adjusted returns as well. So in general, it does outperform on a net basis. Both S&P 500 and MSCI World. MSCI World even more so. But I think again those will be some. That'll be just one angle for you to look at, not the only angle. So yeah, I mean, even on a net basis, this will still be much better.
Right, wonderful. Okay, great. So that's all for this segment now. Later on, Ritesh, you have a slide that you will cover the fee structure.
Correct.
Okay, I'll meet.
So let me quickly cover REITs, and then I think it's already 8, so we will quickly go over the last set of questions and the fees and the platform and everything.
Yes, that's right. We have until now. Go ahead.
All right. Okay, so what is the REITs portfolio, right? So I think essentially the REITs portfolio is composed of all the largest, the most tradable REITs in Singapore. The way we achieve that is because we have a partnership with the Singapore Stock Exchange, which allows us to invest into this index called iEdge S-REIT Leaders Index. This is the most, one of the more popular indices in Singapore, mainly because it contains the largest and the most tradable REITs in Singapore as well. So if you look at some of the highlights of this index is created by SGX to track the largest and most liquid REITs in Singapore. It has a strong capital appreciation and attractive dividend yield of 5+%. This index is diversified. It is screened in terms of having companies and REITs which are fairly liquid. They are traded. They are overall exposure is managed such that no one particular REIT or REIT sector sort of dominates the portfolio. So there is a weight cap of 10% in terms of having that portfolio diversification, as well as on a sector-wise standpoint. As I said earlier, it has components beyond just the typical things that you see and you hear in the news that okay, retail malls are not doing well, so REITs might not be doing well. Not true, and not fair to say that, because REITs also have different subsegments, and I'll come to that in the next slide. So if you look at this, the top 10 constituents, while the IHS REIT Leaders Index does have the commercial, capital and commercial trust, the mall trust, and the Maple Tree Commercials Trust, it also has fair bit of exposure to Maple Trees, the logistics, the industrial, the data center, and beyond Singapore as well. There are certain instruments which are basically in China and other regional countries as well. Even though it is a more Singapore-centric portfolio, but the idea is it's a diversified portfolio across different segments. And what that means is, even though office and retail malls might not have done well during the pandemic, the logistics and industrial REITs have done tremendously well, and data centers have done tremendously well during that same time. So they've mitigated, and similar to what you have observed in the global equity markets, where the tech sector and other growth sector and digital first sectors have really dominated the returns. The more demand heavy sectors are still lagging behind. But again, that's also an opportunity that when the tide turns and economies open up, potentially these office and retail malls, can be considered as value investing, and they will, sort of again give you that upside when they recover as well. So in a way, if you're investing into a broad-based index, you don't have to sort of again pick and choose. You get the best of everything, right? So that's the idea of having this REIT index. And again, on our platform, we have the choice for you. There is a 100% REIT portfolio, which, as I said, invests into the IHS REIT Leaders Index. But at the same time, we also have a lesser risky option. And this, I think, is a fairly good proposition for people who want to, get a little bit, juice up their dividends and juice up their return rather than the money sitting in the bank account. We have a risk managed REIT portfolio, which basically is a combination of REITs and Singapore government bonds. And this portfolio currently has 50% REITs and 50% Singapore government bonds, which basically means that the risk of investing into a REIT-only portfolio is mitigated by having exposure to high-quality government bonds, which will remain very, very stable and overall protect the portfolio from having too much drawdown risk. So again, this portfolio, the risk-managed one, follows similar principles as what we have in our global portfolio, where we are targeting a 15% drawdown risk. And the idea is for you to sort of give up a little bit of the return, but have more stability and get a little bit better return than money sitting in the bank account, right? So this could be that kind of a portfolio, and especially in these uncertain times, this could be a good portfolio for you to invest in without taking too much of a hit if the market crashes, right? So I think something for people to note, and these are portfolios between which you can switch without any cost as well. So at any point of time, you start off with maybe the risk managed REIT portfolio, you become more comfortable, you can switch over to 100% or vice versa. In terms of performance, again, for this year, the REITs market, this is end of October data. So there was another hit in the REITs market because the Robinsons Mall closed down. So there was negative news. So the 100% REIT portfolio took a hit and it went down like, close to 11% for the year. But now, as we speak, this is, come back, and the REITs market is only like 3-4% down for this year. The risk managed REIT portfolio has done better. And that's again because of the bond portion of the portfolio, which has kept the returns almost flat. But as you extend the time horizon, what you will observe is the 100% REIT portfolio starts to outperform the returns on a more longer term basis, like 8 years, 10 years and beyond, you will see that the 100% REIT portfolio starts to give you better returns because there is bigger capital appreciation for you to have. And again, from a dividend yield standpoint as well, the 100% REIT portfolio is, if you want to maximize your dividends and dividend yield and cash flow, you go for the 100% REIT portfolio. If you want to contain your downside and have a more stable investing experience, but still want a little bit better yield than what you get in the bank account, I think somewhere around 4% odd dividend yield in the current circumstance is what the risk managed REIT portfolio will give you, right? So that's the way to think about these two. Now, I think a lot of people ask us that question that, why should we, invest into the REIT portfolio? We can do it by ourselves, pick the, REITs ourselves and create our own portfolio, or we can invest into a REIT ETF. I think very important that, this covers very, very transparently why the REIT offering is so, sort of popular. Mainly because, yes, you can't choose your own REITs, but we do that screening for you in choosing the largest and the most liquid REITs. So the most high quality REITs is what we are choosing. But on top of that, you look at all these other points. There is no trading fee. You can come in and out any point of time. You can invest on a regular basis as a, like DCA without any cost or, minimum transaction, sort of threshold to be met, right? So if you are, on the other hand, buying and selling through a brokerage platform, typically you will be hit like with a minimum brokerage cost. So you can come in with very small amounts and accumulate as you go rather than worrying about management fee. We do have a small management fee, but what you get out of it is, I think, much more valuable because you can start with any amount that you can think of. Rights are automatically subscribed to. Like, again, if you are doing it by yourself, you need to be aware of these rights issues, and there have been a fair bit of rights issues. And these are things that, again, if you're not on track, you might lose out and you get diluted and you again, suffer. And the best part is dividends can be either paid out to your bank account or they can be automatically reinvested. What we observed is if you choose to reinvest your dividends automatically, you on average increase the returns by at least 0.5%. What that means is, on average, you pay around 0.5% to us as management fee. Just this feature of dividend reinvestment actually covers that cost already. So in a way, I think if you think about all transaction costs borne by us, all dividends getting reinvested, very, very low capital requirements for you to start off, rights automatically subscribed to, I think it's a very powerful offering. And even if you compare against a REIT ETF, you also pay transaction cost, but on top of that, you don't get dividends reinvested, and you also pay ETF management fee, which tend to be like, if you look at any ETF, REIT ETF, you're paying around 0.6%. And on top of that, you're paying transaction cost and dividend reinvestment cost. So you'll end up paying 1+% when you're doing that, right? So again, I think from a value standpoint, I think it's a really, really good offer. And I myself very pro it, and I invest a substantial sum with the REIT Plus portfolio as well. Now, I think I would wanted to talk about approach to investing and all as well. Typically, we recommend a core satellite investment approach. This is things that you might have heard about, and typically, again, given that we have news, ideally you would want to create a core portfolio. Core portfolio typically is a multi-asset class portfolio. What we then recommend from core perspective is have the global portfolio as your core, because it is spread across equity, bond, and gold. And then think of satellite portfolios as single asset class or single theme-based portfolios. So whether it is your own individual stocks, your own individual sectors that you've invested into, or in our platform, we will call the equity 100 and the REITs portfolio as satellites because they are concentrated on single asset classes, right? So I think overall, you can have some sort of a framework like this when you're investing onto our platform. There is also a sample case study. So we have a full-fledged advisory team which can help you think about the different goals that you might have. And then if you have a substantial lump sum to deposit and all, we can help you think through how much to invest into each portfolio to cater to all the goals, and also project your returns forward to think through how that money will grow to sort of solve for those requirements that you have, whether it is passive income, whether it is growth, whether it is children's education, retirement, or you want to buy your holiday home, right? So all of these can be done within our platform and in a very sort of, as I said, hassle-free manner, rather than you doing it through a brokerage platform where, again, you have to constantly monitor, and it is not easy to segregate and think through what you are sort of really solving for. So I think before going into how to get started, I'll quickly pause here again. Or Richard, do you think I should continue, and let's keep all the questions at the end?
I think we can keep the questions till the end, because just a few questions on REITs, and I think at the end we can take it, because we are arriving at the past the three segments already. So go ahead and continue.
All right. So very, very easy to get started on our platform. We have our platform available, whether you go onto our website, www.syfe.com, SYFE, or you can access our platform on Google Play as well as Apple App Store. So you can download our app. There will be a Get Started button. You can choose one portfolio to begin your investment journey with us. There will be a few questions that you will be asked. Once you answer them, we will recommend, if that portfolio is suitable for you or not. And then once you're comfortable with the risk and everything, you can see the forecast of the portfolio. Once you're comfortable, you can actually go ahead and create your account. You will be shown the portfolio constituents even before you will create your account. So after you go through the risk questionnaire, you will be shown the components of the portfolio and the past returns and everything, for you to transparently see how this portfolio looks like before you actually create your account. So once you're comfortable, you can create your account. And again, after creating your account, all the things will be transparently shown: current value, the amount that you've invested, the actual underlying components of your portfolio, each and every ETF or REIT that you hold, and in what proportion you hold. All transactions will be recorded and shown. Any dividends that you collected will be shown. Any fees that you pay will be shown as well. So very transparent in terms of using the platform. The best part of it all is we have bundled everything together. You don't have to worry about any hidden charges. There is no trading fee. There is no entry cost. There is no exit charges. There is no minimum balance. There is unlimited, you can withdraw your money for any emergency purposes, any point of time, without any questions. There will be no penalty. In our case, we also take care, without any extra cost, any rebalancing and re-optimizing of your portfolios. Dividends are automatically reinvested for your global and equity 100. For REITs, you have the choice of reinvesting the dividend or paying it out on a quarterly basis to your bank account. For equity and global 100, there is a small ETF management fee that is applicable, but for REITs, there is no ETF fee, because we directly buy the underlying REITs, right? So as I said, very, very transparent. There are different levels of fees that we have depending on how much you invest with us. So there is no minimum investment amount, so you can start small. Once you cross over 20,000, your fees comes down from 0.65% to 0.5%. If you cross over 100K, then it comes down to 0.4%. And at 500K, you can also get more curated advice from our wealth advisors to construct your portfolios in a very custom manner as well. And again, the more you invest, the more dedicated advisory you get as well. So we have a dedicated advisory team, and as I covered earlier, the case study, we can really make a plan for you and help you get started in a proper manner, alongside sort of doing regular portfolio reviews as well, right? So those things also come the more you invest with us. I think I already covered some of these things earlier, in our platform compared to a DIY strategy. There is no minimum. You don't need a CDP or brokerage account. It is super fast. You can get yourself onboarded through MyInfo. You have risk management, which is already embedded. Automatically rebalancing of portfolios and re-optimization happen. Dividends are automatically reinvested. There is no brokerage fee, and the management fee is then sort of all-inclusive, including all of these features and options that I talked about, versus in a DIY approach, you have to sort of think about each and every one of them on an individual basis. Plus, if you invest into a unit trust and stuff like that, there is extra management fee that you're paying on top of all of these other things, or ETF directly that you're buying. You have to pay all of these as well. There is also an upcoming webinar. So this is next week. Actually, this is also something that I will be covering. And again, because of our partnership with SGX on the REIT portfolio, we will be doing a webinar with their head of index services. So this will be happening next week. So feel free to join us. And if you want to get more deep dive and color on the REITs market in Singapore, please feel free to join for this next week. As I said, we have a dedicated advisory team. So if you want to do, pick our brains and help you construct your portfolio on the Syfe website, there is an advisory page. So, you can go there and schedule a call with us. So I think that covers all the things that I had in mind. Richard, happy to take some questions at this point of time.
Right. Okay. Thank you, Ritesh. Are there still some slides left?
No, I think this is it.
Okay. All right. So in that case, then for all the attendees with us up to this point, especially those watching on YouTube, if you have questions, please feel free to come inside the webinar room so that you can type in your questions in the chat box. So if you are already in the webinar room and you don't know where the chat box is, please scroll around the screen and you should see the chat box there, and you can start typing in your questions if you have any. Okay. So Ritesh, thanks a lot for your sharing, and I'll now pick a few questions that I think should be relevant at this juncture. Okay, I see that Leong is asking that he prefers, or he or she, I'm sorry, he or she prefers the face-to-face communication. Is it possible right now? Or y'all only do it through Zoom or something?
Absolutely. I mean, we can do face-to-face as well. I mean, given the COVID situation, we have been doing a lot of video calls through Google Meet or Zoom as well. But yeah, I mean, just feel free to, book a call first through our portal. So, I can quickly show you how to go about doing that. Like, if you go to www.syfe.com, go to the advisory page and book a free consultation call. If you want more sort of dedicated advice, just send an email to advisory@syfe.com. If you want like a face-to-face conversation and you want to meet up in person, then we can think on those lines as well. So usually we start off with a consultation call, and we can do a video call if you want it to be a little bit more face-to-face. But if you want to meet in person as well, that's also possible.
Okay, wonderful. Let me see. Okay. Now, Lee is asking if can he open a REITs plus, as in a pure 100% REIT portfolio, and also another portfolio on REITs with the risk management.
Absolutely. Actually, you can create and have as many portfolios as possible. You can have even 200% REIT portfolios. Like that's also possible. Ideally, I wouldn't do it, but the platform is very flexible, so you can create as many portfolios as you want and whatever combination you want.
Right. Okay. So just to add on to that answer, I have already played around with the platform. So you can create additional portfolio, and at the point of signing up for Syfe account, they will prompt you to choose a portfolio to start with. Now, at that point when I tried, I was a little worried that I'm making a commitment to that portfolio and I can't change it. So the truth is that it's not like that. It's just, you just indicate your preference. Even until you have got yourself signed up and verified through my info, just within 3 minutes, you can still decide to change the portfolio eventually, or even just don't even invest at all, So that really helped me to overcome my fear of choosing a portfolio right at the beginning to start off with. And I think many of you would know that I created You Savvy, and I'm a huge lover of REITs. So the first portfolio I chose was REITs. So then as I got onboarded, then I explore around and I ask them questions such as, do I need to, can I invest one time, or I have to invest on a regular basis? So the answer to that is actually you can invest one time or invest regularly anytime you like, any amount you like. So I was just like, wow, you mean it's entirely up to me? Then they say yes, So that's great. So it gives me a lot of flexibility. And then the next question I asked is that, just like what Lee have asked, can I create multiple REIT portfolio? One I choose 100% REIT, one I choose with the risk management, and the answer to that is yes. You can in fact create multiple of the same portfolio, so to speak, right? And each one you can allocate different amount to it. You can increase the amount for it or reduce the amount for it. So I'm like, wow, that means it's completely flexible. So, and they say, yes, that's correct.
Correct.
Right?
So I think, like, one thing that I've been talking to clients again from a core and satellite standpoint is, like, on day one, when you are trying to invest. So for example, people who have accumulated substantial wealth and they want to invest a lump sum amount, I think the way I've seen a lot of people begin is they start off with the global and the REITs plus bonds portfolio as their core holdings. And they start off with smaller amounts into equity 100 and REIT 100. And then basically the DCA into equity 100 and REIT 100 to sort of mitigate the risk, but also contribute regularly and average out their cost and all. On the same, there are also younger investors who have a fairly long horizon. They actually, have a very small core portfolio. They just try to maximize the return by only investing into equity 100 and REIT 100. So again, every situation is different and every person is different, and every person has a different sort of risk appetite and other situation as well. So depending on where you are, what you are doing, and what goals you're solving for, you can have any combination as you want, right? So even in this example, you see there are two global portfolios, right? Like, there is 21% risk global, 15% risk global, plus there is a risk managed REIT portfolio here for short term horizon, 5-year holiday home down payment. But for a long term 20-year horizon, the person is also investing into 100% REITs, right? So again, I mean, you can have any combination that you want, and that can solve as many different goals that can come to your mind.
Right. Thank you, Ritesh. And next question come from Lindsay. He said that he have missed the part about how is the minimum amount to invest. And Ritesh, what is the minimum amount?
So there is no minimum amount. So you can start with as small as possible. Bear in mind, like, if you invest, like $100, you will get $5 as dividends for the entire year on your REITs portfolio. So I mean, of course, if you want to, like, I think always think of my REITs portfolio from a standpoint of how much passive income do I want to generate, say 10 years from this point of time. So the way I think about my REIT portfolio is 10 years from now, I want to generate $1,000 a month as my passive income, just in form of dividends. And if I want to achieve that, I need 250,000 Singapore dollars in my REIT portfolio. So if you multiply 250,000 by 5%, which is the dividend yield of the REIT portfolio, it is $12,500, and divide by 12, it is $1,000 a month. So again, I think from a REIT portfolio standpoint, the state that I want to reach is, once I have $250,000 in my REIT plus portfolio, I can just sit back and relax. That $1,000, or $3,000 on a quarterly basis will just keep coming to me, and I'm not drawing from the principal, because the principal will still keep growing, maybe at 3% because I'm taking 5% out from that. But the important point is, then I will be living off the dividends, right? So that's, I think, the way I look at it. Where right now, as an investor, I will reinvest the dividend back to the portfolio in the REITs case and let it grow. And then in 10 years' time, once it reaches a certain threshold, I will use it as a passive income strategy.
Right. Thank you, Ritesh. And on this topic about dividend reinvesting, I have an opinion. So if we let, Warren Buffett's company, Berkshire Hathaway, never pay any dividend, right? Why? Because they believe that they are better at utilizing the money than paying out a dividend back to the investors. Correct me if I'm wrong on that. So either way, if we were to DIY our REIT portfolio, whenever we collect the dividend, we usually can't just go back into the market because there's a lot of work, So, and then there'll be
minimum brokerage cost, right? Like, if you get like $50 of dividend or $100, if you try to reinvest it, you will be, required a $20 minimum brokerage cost. So 20% fee. So doesn't make sense, right? Like, versus in our case, it's free automatically. It just gets reinvested.
That's right. That's right. So whether Miss Cody, your question about whether dividend reinvestment, is it automatic? So Ritesh, is it automatic?
So you have a choice for the REITs portfolio. You can choose to reinvest the dividend or take it out on a quarterly basis, credit it to your bank account on a quarterly basis. So there is a feature of payout. So if you choose payout, then the dividends will be paid out to your bank account on a quarterly basis.
Right. Okay. Lindsay is asking whether she needs to specify if she wants the dividend to be reinvested. Ritesh?
So, as I said earlier, equity 100 and global portfolio dividends will just be automatically reinvested. For REIT portfolio, you have the choice. At the time when you create your REIT portfolio, you will be, given the choice. Do you want the dividends to be reinvested or to be paid out? Even if you say start off by saying that reinvest, and at a later point of time you want to pay that dividends out, you want to change it, you can change it later as well.
Right. Okay, Lindsay, I hope that answers your question. And Samuel is asking whether the returns are guaranteed.
So as I said earlier, I think unless you are investing in a fixed deposit or a savings account, there is no investment that comes with guaranteed returns. If there is such investment, please let us know as well. But again, every investment does come with its own risks, and that's why I think it is very important to sort of look at each different investment option and portfolios and invest into them, not just because they are giving you very high return, but also look at what risk are you taking to generate that return. And that's why, when we sort of advise our clients, we always advise them from a more core satellite approach, and where there are risks involved, we would sort of highlight them to the clients that equity 100 is giving you or potentially will give you very high return, but be ready for that volatility. For example, if you are investing into S&P 500, which is the US stock market index, if you came in February, in March, you invested $100, that $100 would have become $66 by March. That was the crash, $34 loss. But if you remained invested, right now you will be at 105. So the point that I'm trying to make is higher returns comes with higher sort of fluctuation and volatility and all of those. If you don't have the capacity to sort of hold on to your investment, and if you're going to panic and sell, it's actually better to have a more diversified portfolio and have a more peace of mind while you sleep, rather than lose your sleep on a daily basis, tracking the markets and sort of worrying about it, right? So at the end of the day, I think all of us, what we should realize is we want to achieve our goals in a much more stable, steady manner. Even though we want to maximize our return, I think the bigger goal, don't lose the forest for the trees, is what I would say, right? You want to get maximize your return, but in that sort of endeavor, don't end up losing a lot of money as well, right? So try to diversify as much as possible. Try to mitigate the risk that you're taking as much as possible. Try to DCA into the market from your monthly savings. So the ideal way of investing is lump sum investment, invest into a very diversified across asset class core portfolio standpoint. Monthly investment, try to sort of dollar cost average on all your investments, and potentially do bigger dollar cost averages onto your more high risk investments.
Right. Thank you. And let me see. So maybe at this point, before we continue with more questions, Ritesh, I'll just take over the slides from here, and later on, if need, pass back the screen back to you. All right.
Absolutely.
Okay. Okay, great. So back to my screen for a while. Okay, firstly, I want to thank Ritesh and Syfe for sharing with us about what Syfe is all about and the three portfolios that they have. And I believe that we have also seen that Syfe, out of between the DIY method and DFY method, Syfe is more of the DFY method, right? Where we can just choose the portfolio and customize the risk level that we are comfortable with, and then we leave it to them to invest for us. And at this point, I also like to share with you what I like about Syfe. Now, I think we see a lot of Syfe Facebook ads. That's one of the places that one of the reasons why I click it. And then last week, I finally decided to pull the trigger and open a Syfe account. And then I dig around, I ask questions, and then I gather my thoughts and then put down in writing what I like about Syfe. I don't know about you, but maybe you will come to similar conclusions, okay? Because I have been a DIY investor for many years, okay? And I can tell you it's not easy. Okay, and it's really not easy. Okay, for those of you who have invested before, you will know what I mean. So, and like what Ritesh have said, diversification is the only free lunch. Okay, so what I like about Syfe is that I can diversify very easily, okay, into their three portfolios. And for each of their three portfolios, I can customize the risk. I can change it anytime. I can add funds to it. I can remove funds from it. I can create additional portfolios to do my core satellite or anything without the high associated fees if I had to do it myself. Okay, so that's one thing I like about that's the first thing I like about Syfe. And second thing that I really like is that there is no emotions. Once I set the parameters in place, basically I just leave it, and that's the best part that I like about it. You know, I don't have to worry. Wow, is it too high and I'm chasing the high? Or if I buy already, it keep dropping. Then should I sell or should I hold? So because I leave it to them, all right. So I still have my DIY portfolio. Don't get me wrong. I'm not saying I'm going to switch completely. Yeah, I'm saying that I'm going to outsource part of that to Syfe to handle for me. Okay, so the third reason why I like about Syfe is because it has low fees, between 0.65 if you are having amounts that are smaller, and 0.4 if your amounts are bigger. And the best part is that there's no minimum. You know, if we do DIY, can you imagine if you do any buy sell transaction, 19 REITs. We don't talk about the equity 100 portfolio where there are many more constituents. Just the 19 REITs, you have to incur how much transaction costs to your broker, right? Every time you buy and you sell. And how handling the rights issue? How about handling the dividend reinvestment? That's a lot of work, you know. So I'm not saying that you can't do it yourself. I'm saying that you can continue to do it yourself for those REITs that you really like. Okay, so I have my favorites like Keppel DC REIT and Maple Tree Industrial Trust. These are two of my favorites that I have. But to do it for 19 REITs is no joke. And to diversify into 19 REITs is another nightmare. So with Syfe, we can diversify easily with low fees and no minimum. If you add up all the fees, if you DIY, you'll find that you might as well outsource to Syfe because the fees will come out to be lower. Okay. Then the next reason that I like about Syfe is that I can withdraw my funds anytime, right? So if I feel that I want, to be high time in the market, so I just put certain diversify a portion of my funds into Syfe and other robo advisors. I'm not just saying about Syfe, just diversify. And then the moment you feel that you need the funds or you're afraid of something happening in the market and you didn't like the way that Syfe is handling your risk management, you can just withdraw. No questions asked. Or for those of you who like to have regular income, you can also withdraw on a regular basis, right? While Syfe is doing the dividend reinvestment for you. Okay, so this is the last and possibly the most important criteria. And I think Terry asked the question, how do I know that my money is safe with you? So this question is answered, I believe, addressed by Ritesh right at the beginning, and that is Syfe is MAS regulated, and the funds that we deposit with Syfe is in a segregated account. So in case where Syfe disappear from the earth, our money is still safe in our segregated account. Is that correct, Ritesh?
Absolutely.
Okay, wonderful. So these are my 5 reasons. Okay, so I do not know what are your reasons, and maybe you don't like to DFY, and that's absolutely fine. So it's up to you. Okay, so do your own due diligence regarding Syfe or any other robo advisors that you may come across. And the next slide, I'll just like to show you a glimpse into my Syfe account, which I opened on election day, US election day. Okay, now again, this is past performance is not guarantee of future performance. Maybe I just happened to enter at a time that happened to give me the kind of return that you see on the screen. So for me, I do not know which. I started off with the REITs portfolio, and then I decided to say, hey, since they have 3, I will give equal amount to 3. It's like betting on 3 horses, and then I'll leave the 3 horse and I put in an amount that I'm very comfortable with, meaning that it's not big. Okay, I put in an amount that I'm very comfortable with, that I don't intend to ever touch, and I want to bet on these 3 horses inside Syfe and see how far it can go for me. So it so happened that 3rd of November could be the small low in the market, and I happen to make a little bit of returns just within a week and a half. For my REITs portfolio, is up 2.79%. For my global portfolio, is up 0.69%, and for my equity 100 is up 2.2%. Okay, so like what Ritesh has said, if you come in February and you are looking at your portfolio in March, you'll be down by 30%. Okay, so past performance is not a guarantee of future performance. So you do your own due diligence and you deploy only an amount you are prepared to be comfortable with. Okay, so and with that, I'd like to share with you and fulfill my promise to you about how you can get up to 2% more in your Syfe account. Okay, so this is a little trick that I happen to know and I like to share with you. Okay, I hope your Syfe is okay with Syfe. Now, every Syfe account have a referral program, and the referral program allows you to share Syfe with your friends, okay, such as me now sharing with you. And to get 2% more for your friend that you referred to, very simply is to make sure that you enter a referral code. Okay, so how does it work? So this is how it works. Okay, so if you are not already a Syfe client, now please go to syfe.com and you can start the onboarding process. It is very easy for Singaporeans because you can use my info. And if you are not from Singapore, Syfe take clients all over the world. Minimum age is 18. You can also open the Syfe account. So I'll talk about Singaporeans first. Okay, so when you onboard to Syfe, you can use my info, so you'll be very fast. And for funding, for me, I use PayNow. So my funds appeared literally within the next half an hour in my Syfe account. So that's how fast they have handled it. Maybe because I did it in the morning before the cutoff time. So if you enter the referral code WEALTHENJOY and you deposit 500 into your first Syfe portfolio, be it online banking or through PayNow, Syfe within 1 to 2 weeks is going to credit $10 into your account. So $10 out of 500 is 2%. Okay, so that immediately boosts your return by 2%. So this is a little trick that I happen to know that I thought I would like to share with you. And I feel that 500 is an amount that is not too small and not too big to get our feet wet with Syfe and kick the tire and see whether that is something for you, whether you want to allocate more or you want to withdraw the full sum later on. It's up to you. Okay, so that is entirely up to you. And another thing that I found out is that this referral program where you can get $10 more is time limited because they may be pulling this promotion soon. So if you want to get this $10, go for it soon. Okay, and it's only available for new clients and for the first deposit only. So if you deposit $300, then sorry, you don't get the $10. Okay, so you got to put in 500 or more, then you will get the $10. And if you put in 10K or more, you get 50. If you put in 20K or more, you get $100 in addition deposit into your first portfolio that you create with them. Now, if you can do the math, you will know what are the percentages. And if you understand their rules, you will also know that this is a very good deal. Okay, so ultimately, Syfe is the final and sole decision maker, not me. I'm just sharing a little trick that I knew that boosts a 2% more in my Syfe account. Okay, so you can also guess how much I've deposited. Yeah, but I do it for 3 accounts. Okay. All right. So with that, I'll come back to Ritesh. Ritesh, do you have now we have about 8:43? Yeah. So do you have time to maybe take a peep inside the Syfe account for our attendees?
Sure. So just give me a moment. I can share some of the portfolios.
While you're doing that, let me see what other questions there is. Okay. Okay. To answer Andy's question, how do we monitor our portfolio? And to answer your question, there's an app, there's a website. When you log in, you can see exactly what they buy or sell for you, how many shares, how much is involved, how much are the fees, and you can adjust your portfolio anytime you want. So that's how we can monitor our portfolio. The screenshot that you saw earlier from my portfolio is taken from a website. You can also do it on the app. So you can literally see what REITs they buy for you, you know. And you can see how what percentage of your portfolio consists of what REITs. So it's really very transparent. So let me see what other questions that I get.
So let me quickly share, a sample account that I have, and
You need to
how people can navigate. You want me
yeah,
to cover that?
yeah. Please take over the screen. Yeah.
All right. I hope people can see this,
Yep.
right? So here are a few portfolios. So there is a global 21% portfolio. There is a global 5% portfolio as well. This was, I mean, I think in this case, the reason for existence of this portfolio is I used it as a parking facility where I just put the money in. And then if you see, like, the money has been drawn out. So what I've been doing is I put an initial big lump sum into this, and then I keep taking money out and redeploying it into higher risk portfolios. So again, these are all things that are possible in our platform. Then I also have REITs risk managed portfolio and equity 100 portfolio, right? Like, there are all these different portfolios. Plus there are other accounts as well. So I'll only share this one, like, just to get you a little bit more comfortable with the different portfolio options, and like, these are actual real returns as well, right? So for example, the global 5%, let's quickly see. This is the 21%. I think recently it's gone down a little bit, but more because of you see the currency impact. So the portfolio itself has grown, but it's transparently shown that actually there is some return negative. It's gone negative mainly because the USD has depreciated against Sing dollar, and that's been the case for a lot of investors. If you're investing in USD denominated assets, the USD has come down from like 1.4 per Singapore dollar to 1.35 right now. So even though my portfolio overall made money, like it's lost some money here. But the important thing to highlight is each of your portfolio constituents are shown. So these are the constituents. You can go back and you can see each and every transaction is recorded, right? And as I said, rebalancing history is shown, dividends received are shown, any fees that you are paid are shown. You can also change the risk of your portfolio at any point of time. So this is for the global portfolio. There is also a manage funds button. If you click on it, you have the option of adding more funds. You have the option of transferring funds. So this is what I've been doing from the 5% portfolio, where I put in an initial big lump sum and then I keep transferring it over to higher risk portfolios over time. And then you can also withdraw your money here itself. Then quickly in the REITs portfolio, I think even more information. You can see each and every REIT, the bonds, everything is mentioned transparently. If you again go back, all transactions are recorded. This is something that I showed earlier as well. You have the option of reinvest or payout. So this portfolio is on reinvest. So the idea is, as and when these dividends are received, they just get reinvested back to the portfolio, right? There is also an option at any point of time. You can actually change the composition from risk managed to 100% REITs or vice versa. So, cancel for now, but this is also available. And then lastly, the equity 100. So as Richard was also covering earlier, just lucky that this portfolio got invested at a time when the market is like going fairly high enough. So it's pretty high in terms of return, and this been invested only for since 24th September. So within 2 months, less than 2 months, it's grown 7.5%. So even though this portfolio also suffered some negative impact due to currency, but the returns are substantial enough to mitigate those currency impacts per se. So again, all the data is shown, each and every ETF is listed, and again you can go back, see all transactions, fees, and all of these information is available at your fingertips basically. So hope this is useful. I will go back to the slides, and Richard, any questions? Happy to take them.
Right. Okay. Thank you. Now, let's get back to the question in the last 10 minutes of this webinar. Thanks for showing us around inside the Syfe account. Okay. Yep. Okay. Let me see. I shall take back the screen for now.
Yep.
Okay. Right. Let me see what question. Okay, Chris is asking about the fee structure, the 0.4 or 0.65. Let's say he starts off with, his example here is that if he starts off with 50K, which then incur a 0.5% fee, right? And the AUM
Correct.
grew beyond the what do you call that? The
100K.
to qualify for the next lower tier. Does it happen automatically or?
Automatically. So as soon as your investment amount crosses a particular threshold, from that day onwards, you start to enjoy the lower tier fee. I mean, sorry, the lower fee under the higher tier.
Right. Okay, good. And then Mitchell is asking whether you accept US dollar deposit instead of Sing dollar.
Yes, so we do accept US dollar deposit, but for USD, there is a 10,000 US dollar minimum for each transfer. So make sure that you transfer more than 10,000 US if you're sending US dollars. So if you do send US dollar, then the US dollar just gets invested directly. We don't need to convert from Sing dollar to US dollar and then invest.
Right.
This is relevant more for the equity 100 and global portfolio. For REITs, it's a Sing dollar portfolio, so we expect most of the clients to sort of send Singapore dollar. And again, there is no conversion then because it invests in Singapore dollar, SGX listed REITs only.
Right. So global and equity 100 are US dollar portfolios. So if they fund using US dollar, $10,000 per minimum per time, there is no FX to deal with, right? So, okay. So for REITs, it's a Sing dollar portfolio. So if you transfer Sing dollar, then there's no FX to deal with.
Correct.
Okay, good.
And Singapore dollar, whether it is global or equity or REITs, there is no minimum, and you can start with any amount.
Right. Okay. So Chris is asking, how are the FX rates managed? Are the forex loss and gain that is shown paper, loss or gain, or is it realized?
So as long as you have the portfolio, these are all paper losses. And again, the fact is that on a short-term basis, the currency impact might seem high because the rates do fluctuate on a day-to-day basis. But what we have observed is over a longer duration, if you're investing for 5, 10, 15 years for your long-term goals, the portfolio returns far dominate any currency impact that you might see on your returns. And given that if you're regularly contributing to your portfolio on an ongoing basis, you actually average out even your currency risk because you will, if the USD continues to appreciate and you keep putting more Singapore dollar and converting to US dollar, you keep averaging in, and averaging your, sort of FX risk as well. So over time, like the FX risk is very minimal. And most of your returns, on a even FX adjusted basis, is pretty significant. And compare that again to what are your local investment options any which ways. If you're looking for a more growth oriented portfolio, like beyond REITs, there are very few options that can give you that 7, 8, 10% kind of returns in this market.
Right. Okay. Thank you, Ritesh. And the next question from EC. EC is asking whether if he or she were to put in the first portfolio $500, how soon would that amount be invested?
So we have a 11 a.m. cutoff. So as long as all your KYC and everything is complete, plus you make sure that when you transfer over the funds, you do it properly with the right sort of tagging of the account or the portfolio that you want to invest into, and that will be shown transparently how to do that and on our website when you are trying to add funds to any of your portfolio. As long as you do all of those and the money reaches us before 11 a.m., then it gets invested on the same day.
Right. Okay. Thank you. And Mitchell is asking whether he or she can maintain two currency accounts without incurring exchange losses. So I guess what he or she is trying to do is maybe to fund the global account and the equity 100 account using US dollars, and then fund the REITs account using Sing dollars. Is that possible?
Absolutely, yeah. So I mean, you can transfer, in US dollar or Sing dollar, and for different portfolios. I mean, as long as we receive money in these two currencies, and we will invest it for you.
And therefore, no exchange losses, right? or gains?
So if you're transferring USD, then there is no FX losses, right? So to be worried about. So we'll just invest directly the US dollar.
Right. Okay, good.
But
Okay.
you can have your REITs portfolio and transfer Singapore dollar to it separately. That's fine.
Okay, thank you. Let me see. This question is from K. K is asking, with your fees being so competitive, is this platform sustainable? As we talk about investing is long term, because the fees are so low, are you able to sustain yourself?
So I think this is something that I covered earlier as well. The fact that we are a digital first platform, what that means is we have built this platform on day one with a huge focus on utilizing and leveraging technology. What that means is we are not paying external vendors, or we are not utilizing a lot of human resource to do all the different tasks associated with portfolio construction, overall asset management, and other processing of your investments, all these other features that you see. Actually, we have all implemented it using technology. What that means is, even though our cost is our fees are so low, and potentially we operate under very razor thin margins, over time what will happen is, once we have a substantial amount of asset base, and that's already happening, where we have started reaching economies of scale. Economies of scale basically mean that as you build a technology platform, for each incremental client that comes in and funds that come in, you spend less and less, because the technology platform is built. So you don't pay extra, and you don't have to hire an extra person just because new people or new investors are joining the platform. So that's the beauty of technology, where if you build a very scalable system, the incremental cost is very, very limited. And at a certain stage, what happens is you start to enjoy economies of scale, where then essentially you can actually think of further reducing your cost, rather, right? Because essentially the platform is built to be super transparent, to package everything together, bundle everything together. And at certain point, what will happen is we will operate under a model where we will keep passing more and more benefits back to the clients as we achieve more and more scale.
Thank you, Ritesh. And next question comes from Ella. Ella is asking, would you recommend alternating your portfolio between REITs with risk management and REITs without risk management? And, along the questions, someone else was asking, if they need to speak to someone for advice, how they should construct their portfolio in Syfe, whether there's someone that they can speak to.
Yep, absolutely. So on the second question, you can actually, again, as I said earlier, go to our website, www.syfe.com. There is a tab called Advisory. So click on Advisory, and if you scroll below, you will see a free telephonic conversation, sort of link. So just go through that, and you will be linked to my team of wealth advisors, and you can set up a time with them and speak to them face to face via like a video link, or if you are planning to do a more sort of serious investing, then you can sort of also meet them in person. So definitely possible to have a very in detail sort of personalized sort of conversation with us. What was the first question again, Richard?
Let me scroll and see. Oh, her question is whether would you recommend alternating between portfolio and with risk management and without risk management?
I think it really depends on your goal and what you're trying to achieve from the portfolios. So usually I use the portfolios and I invest into them in a very goal-oriented manner. So typically, if I have a shorter-term time horizon and I want to keep my money in Singapore dollar, but get better interest in the bank account, but my goal is, say, 2 years from now, I will actually think more on the lines of the risk-managed REIT portfolio, because I don't want the portfolio to suddenly have a big drawdown and not be able to achieve my goal, which is a short-term goal. Versus like if I'm looking to generate passive income over a longer duration, and I want to just maximize my dividend yield, then the 100% REIT portfolio could be relevant, because even though it might be more risky, but the fact is that I'm investing for long-term, passive income, and my investment horizon is 10, 20, or lifetime, right? Because you never need to take money out of that REIT portfolio, because, essentially you can generate dividends from it for your entire lifetime, right? So for that kind of a goal, I would start getting more comfortable with the 100% REIT portfolio and keep growing that as well. So it really depends on your goal and your intention. But yes, I mean, the optionality actually exists, where you can easily sort of switch between the two portfolios, change composition, and stuff like that.
Right, thank you. Okay, next question comes from Andrew. Andrew is asking, for equity 100, roughly how many stocks are inside, and whether the investor are informed exactly what
Right.
their portfolio. Yeah.
Absolutely. So the portfolio itself is transparently shown. I think I showed it in my dashboard as well, that each ETF and the proportion of each ETF that you hold will be shown. Even each transaction in terms of what ETF was bought at what price, that will be shown. So all of it is transparently shown to you. Typically, our equity 100 portfolio has over 1,500 stocks, because the ETFs that we choose, each one of them have hundreds of ETFs, hundreds of stocks within them, as a component. So you end up investing into 1,500 plus top companies across the world. So very, very diversified. And again, you're investing in some of the largest corporations, the most successful companies in the world.
Right, thank you. And the next question comes from Mitchell, and I think he or she is asking about the withdrawal. Now, her earlier question is about depositing in US dollar for the US dollar portfolio and maybe Sing dollar for the Sing dollar portfolio. So this follow-up question from him or her is to follow up on whether the withdrawal is the same. That means if he or she withdraw from the let's say global portfolio where he or she put in put in US dollars, will the funds be taken out as US dollars as well?
Correct. So you can choose at the time of withdrawal whether you want to withdraw in US dollar or Singapore dollar. You can do that.
Right. And then is there a minimum of fees involved in withdrawing in US dollars?
I don't think so. Yeah. So you can withdraw partially as well.
Okay, and the next question is from EC. EC is asking whether SGD 10,000 minimum for a lump sum investment. To answer your question again, there is no minimum. That's one of the reasons why I think Syfe is interesting to me, because there's no minimum. For Sing dollar, there's no minimum. Okay, for US dollar, there's a minimum of 10K, correct, Ritesh?
Correct. Absolutely.
Yeah. So if you're talking about Sing dollar, you want to use Pay Now to fund, there is no minimum and no lock-in. Yeah.
No,
So whenever you have extra cash, you can put it in to work for you. Whenever you need the money, you can withdraw. So there's no lock-in, no minimum for deposit and withdrawal if done in Sing dollars. Correct? Okay, so with that, I'd like to, if you have any last questions, please post them in the chat box. Otherwise, now I'm mindful of everyone's time and I don't want to take more time than what we have committed, so that you can get on with your night. So I'll just like to take one or two last questions and then we will call it a night. And then let me see. If you have any further questions, please feel free to contact Syfe directly. All their contacts are on their website. Go to syfe.com and click on the appropriate buttons and you can find how to reach them. Their office are also in Singapore. You can schedule a time to talk to them if you need to, and also follow up with any additional questions. So this question that just came in from Samuel. Samuel says that if he invests a lump sum of 250K, can he get dividend monthly?
Okay. So while you on the portfolio basis, it's only a quarterly payout. But as I said earlier, the platform is super flexible. What that means is on a monthly basis, if you want to take the dividends out or do partial withdrawals, you can just take money out and just take, like every month, just go take, whatever amount you withdraw, just take it out. So the platform itself, from withdrawal perspective, cash flow, you can do, manually, go to the portfolio every month, end of the month, just specify the amount and the money will get credited to your bank account. For us to do it on an automatic basis, that's where we do it quarterly, because again, we want to be sort of conscious in terms of our processing costs and everything. If you have smaller accounts, if you start paying monthly dividends, it will be like $10, $20 kind of thing. So we tend to sort of standardize the payout mechanism. If it is automatic, we only do it quarterly. But if you have a substantial sum and if you want to take money out, just like go to the website, log into your account and just do partial withdrawal anytime you want.
Right, thank you. And I think I'll take the two last questions that are already on the screen right now. One is by Lee. Lee is asking whether he could put Sing dollar into the equity or global portfolio.
Yeah, absolutely. You can put Sing dollars. And again, we have very competitive rates in terms of converting your Sing dollar to US dollars. So, it's not like the bank where, number one, you will not know what rate they use. I mean, and then number two, the cost of transferring or converting will be like 0.7, 0.8%. So in our case, we don't earn anything when we convert your money from Sing dollar to US dollar, and it is done at 0.09%, right? So each time you convert Singapore dollar to US dollar, it is converted at 0.09%, which is like almost nothing in my opinion. So really low cost, and it is done at market rates. Right?
Thank you.
So very transparent in terms of how it gets done.
Yes, indeed. Okay, the last question is from Samuel, a follow-up question to his earlier question of the 250K. So he said, if he were to be withdrawing on a monthly basis, how would he know that he's not touching the principal or drawing on the principal too quickly,
Yeah, so actually, I mean, at any point of time, you will be able to see the current value of your investment versus how much you invested. So if there is a profit and you're taking out, you're still in the money. Plus, you will also be able to separately see how much dividends you have collected, and it's still lying, in your account. So you can take that out, right? So in a way, it's fairly transparent and easy to understand and see, like, if your portfolio is down for a particular month, maybe you don't want to take money out this month. In the next month, if you receive, like, also the REITs, the way they pay dividends, it can be, it can be the case that in 1 month there is no dividend that you receive, but in another month suddenly 5 REITs pay dividend, and there is a big amount of dividends that came in. So that's why I think when we do it quarterly, it gives a certain amount of stability in terms of the amount of dividend that you receive, because we pool together all the dividends that came for the entire quarter and then pay it out to you.
Right. Okay, Samuel, I hope that answers your question. You can see your P&L, and then if you are in profit, you can withdraw. So that will surely means that you're not touching your principal. Okay, and with that as the last question, thank you very much, Ritesh, for your time with us. Thank you for your sharing, and we hope to all the best for Syfe, and also all the best that you're helping all of us help make money for us and also for you. Okay, and any last words for our attendees?
Absolutely. Great pleasure to be here. Thank you for having me, share my views as well as the Syfe platform with your community. And I think the only last word that I would have, and this is, something that our CEO speaks fairly often, it's really the time in the market rather than timing the market that will help you generate wealth. So focus on time in the market. Don't, be trigger happy. Invest for your life goals, invest regularly, diversify, and that is what will over time help you generate wealth. So that will be my closing points.
Thank you, Ritesh. Thank you for your time. And again, all the attendees out there, Thank you for your time as well. And don't forget, if you are wanted to open a Syfe account and kick the tire, please use the Wealth Enjoy promo code Wealth Enjoy, and then you will get $10 for $500 deposit. So remember, this is only for new clients and the first deposit only. And this time limited offer may be put anytime. So if you want to catch hold of it, please grab it soon. Okay. And the last thing is that to keep posted of our upcoming webinars and other interesting wealth building education opportunities, please join our Telegram channel, Wealth Enjoy. And with that, I wish everyone all the best to you and have a great rest of the week. And Ritesh, you too. Good night.
Thank you so much.